Hi everyone, this is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest, but I haven't had him on in a while. He is a former hedge fund manager. He's a co-author of Silver Manifesto with David Morgan. He's a senior analyst at the Morgan Report. He's a follower of the Austrian School of Economics. And a long time ago in 2011, he co-authored the Treasure Hunting for Precious Metal Stocks report with me. Chris Marchese, thank you for coming back on.
Great to be with you, Jason.
Now, Chris, before we talk about the gold market and the silver market, which I know you guys cover extensively at the Morgan Report, I want to ask you about what's going on in the global economy and with this central bank intervention. In your opinion, how would you define 2017 with the central bank intervention? And what do you think do you think the central bankers have a viable exit strategy for removing liquidity in 2000?
No, I don't think they have any viable exit strategy whatsoever. I think they are just trying to hike rates right now so they have some ammunition to fight off the next recession, depression, whatever you want to call it. But it won't work next time. If you go back to 2008 or 2007, 2008, they started from about 5% and were able to lower rates to 0. Now they might be able to get it to the Fed funds rate to 2%. It's 2 more hikes if they're lucky. And so then they only have 2% to lower it. But during the next recession, depression, I think they will go below the 0 bound. I also think, based on what they said a couple of weeks ago, that the QE programs are a policy tool, implying that they will use that again in the future if need be. And, that's very telling of their mindset. Then you also have to go back in time and look at various FOMC minutes, starting with Greenspan, Bernanke. When Bernanke was at the helm, they talked several times about fixing the yield curve. Interest rates on the long end got too high, and the cost to service national debt became a problem. So that's always a possibility. In China, last year, they announced that starting in 2018, there would be a slight reduction in the reserve requirement. So basically, they can inflate the amount of credit by a greater degree. And even though the Fed said they began winding their balance sheet starting in Q4 last year, if you looked at the end of Q4, it didn't shrink at all. It actually increased very marginally.
So it appears.
And I think a lot of this is, they're trying to play a psychological game with the market.
So it's been all talk so far. So you mentioned China. It looks like China was in better shape 10 years ago before they went on this enormous Keynesian stimulus package. The People's Bank of China balance sheet is just enormous now. It's gone up, I think, about tenfold with the amount of debt they have since the 2008 financial crisis.
That's true. But the one thing I will say about that is at least they're using a good amount of their reserves to buy gold and other hard assets. That means a lot because the Chinese have mentioned that in the future they plan to back their currency by a basket of commodities. And you read reports of what the PBOC has bought, but that's only on gold that was declared monetary when it was imported. There's all this non-monetary gold that they can buy without anyone knowing. We don't know what that amount is, but I have a feeling it's quite a bit. The same goes for Russia. They've been buying a lot of gold.
Those are great points. And Russia and China also, they mine a lot of gold and they don't allow the gold to leave the country.
Yes, China's consumed more gold than they produce since I can remember after following the financial crisis.
Yes, and China's now the number 1 gold producer in the world, not South Africa, because South Africa is a freaking mess due to their government geopolitics. I want to ask you now about the stock market. So the stock market went parabolic in 2017. The central bankers, it wasn't the Federal Reserve as much as it was the Bank of Japan, the European Central Bank. They drastically expanded their balance sheets in 2017 with liquidity programs, and they bought over $3 trillion. A lot of it, I think, went into U.S. capital markets. Do you think then this 10% correction we've had in the last 2 weeks is a sign that a lot worse is yet to come and that there's going to be the new normal going forward is going to be a lot more volatility?
Oh, yes, there will definitely be a lot more volatility just because the economy is not nearly as strong as people think. It's hanging on by a thread. We're in the second longest economic expansion, if you want to call it that, in recorded history. They're hiking interest rate. The dollar's weakening. Yields are going up. next year, fiscal year 19, the budget deficit is forecast to go up, balloon back up to 1.2 trillion. That amounts to more debt. And just eventually, everyone's going to realize that we're stuck between a rock and a hard place.
So you mentioned the yields going back up, but it seems that the yield curve is flattening. It's not gonna go steepening yield curve. Like ideally for the central banks, they want steepening yield curve so the banks can make more money lending out the money into the economy. But it looks like the yield curve is flattening even more and may even at one point go inverted. So do you think that a bond bear market has started?
I don't know because of what because they can't keep the 10 and 30-year yields too high. They can't let it go too high because that will cause the government interest payments on their debt to go out of control. So, if they were to go to, say, 4%, that would cause a pretty big increase in the budget deficit, and I don't think it will, and they could even freeze the yield curve if that happens.
Chris, this is kind of like what the problem Japan has, because remember Japan, the People's Bank of Japan said, the Bank of Japan said recently that they were going to stop doing their liquidity injections, and then the bond yields started to rise, and then the Bank of Japan had to go back in there and intervene and start buying up more bonds because they can't afford the yield spikes like what you said. The Federal Reserve seems in a similar predicament.
Yeah, and especially if you combine that with their plan for supposed 3 more hikes this year, unwinding of their balance sheet, because if they say what they do, they will unwind, almost $1 trillion over the next 2 years. And the market can't handle that. The debt markets can't handle that. And we don't even know the quality of all these assets on the balance sheet. Presumably, they're the worst of the worst. That's why they're still on the Fed's balance sheet. Instead of having a bond auction, why doesn't the Fed just, instead of them raising rates, why didn't they just unwind their balance sheet faster? Because that would have too caused upward pressure on interest rates. It doesn't really make a lot of sense.
So you expect them to start, instead of reducing their balance sheet, because it's been talked, Yellen for a while now has been talking about reducing the balance sheet. Now that she's gone, they haven't done anything like you said. So you expect that to continue to be all talk and no action?
I think they'll start to unwind a little bit. I don't think the economy is in good enough shape and will stay in good enough shape for them to reduce it by any meaningful degree. Because I think it's supposed to be at either 10 or 20 billion a month.
Well, we'll see what Jerome J. Powell decides. Now, Donald Trump has done some things that looks like it's going to be bringing more inflation or stagflation back into the real economy. These Trump tax cuts that corporations have enacted, there's been a small amount or decent amount of wage increases. Long term, you brought up that the deficit is actually going to grow. So yes, the real economy, I love tax cuts, but there was no actual cut in government spending. So long-term tax cuts are nice for the private sector, but the government didn't cut its spending. So this is really bad supply-side economics, still central planning. So do you see then that the velocity of money, that the inflation is going to pick up because the velocity of money in the real economy is going to increase with maybe wage increases?
I don't think so. I don't think the velocity will pick up because it would have if it was going to already. And, if you look at the savings rate, that hit a 8-year low in January, I think, at 2.4%. So there's not a lot of more spending the average person can do. They don't have any savings. And in fact, the average American's a huge net debtor.
Yeah, I agree. It's the example of this that a lot of people, despite warnings, have been buying cryptocurrency on credit cards.
Yeah, and it's hard to no one knows what the velocity will do, but once we do get, we've gotten a sharp increase in producer goods. It just hasn't gone to consumer goods yet. Once that does happen, it's going to escalate very quickly. And once that happens, if people think prices are going to continue to rise, velocity picks up. And, I don't see any way around a currency crisis in the U.S. next decade sometime, unless there's some type of monetary reset or the U.S. defaults on its debt, but the U.S. doesn't have enough integrity to do that.
That's a good point. Yeah, the dishonest way to default is to just keep, using fake government economic statistics and say GDP is good, the economy is good, inflation is low, and then just keep creating more and more more money in credit and hope most people don't even notice. So that rising producer price index that you mentioned, that would seem to me that consumers then are going to get less goods and services, less purchasing power for more. They're going to have to pay more money to get less. So that would seem to me to be stagflation. So you would, as Austrians would call misallocation of capital, Keynesians would call it cost push inflation. Is that what you see coming as worse stagflation then because of this intervention by the central banks?
Oh, yeah. And, I think there will be another crash like 2008, but on steroids in the next 2 to 3 years. I don't really see how we're going to make it through fiscal year 19 without a sharp recession. And at that point, I don't think once at least the onset starts, I don't think we're ever going to get out of that because of all the structural issues that are in the economy.
And I know you follow the Austrian true money supply, which a lot of our listeners might not be familiar with. Is that predicting right now that inflation, monetary inflation, is starting to pick up a lot?
No, it's growing about 7%. It was growing upwards of 11, 12% when the QE programs were in full effect. But if you look back on the true money supply, when the rate of growth has decelerated, that's usually forecasted recession. I mean, I'm not saying that using it as a tool to forecast one, but
so you're just
there is inflation. It's just the velocity isn't there right now.
So it's gone into asset prices. So it's gone into the capital markets more than the real economy.
Yeah. Then you have to look at the other side. Credit in 2015, total U.S. debt's also, it's just the other side of credit, was $60 trillion in the U.S. national debt plus private debt. And now it's $70 trillion. Jim Rickards says it's $80 trillion. I don't know where he gets that other $10 trillion from, but he could very well be right. And you couple that with growth in the money supply, prices will rise even if the velocity doesn't pick up.
Yeah, I agree. I think we're going to see a lot more stagflation in the near future. I mean, I'm already seeing it now in my bills, my food bill, rent. I live outside of Washington, D.C., though, so it's very expensive to live here. And
the one thing that might mask it for a while is, so Trump got that spending bill through the Senate a day or two ago. That $400 billion is, that extra government spending, that's going to count towards GDP growth, even though they're just issuing more debt to do it. So that could mask it for a while. And this tax cuts as well, corporations might make more or larger capital investments. We'll see how that plays out.
Yeah, the Atlanta Fed is projecting, a 5% GDP for the first quarter of 2018. That's a record high, but that's not counting the real inflation rate. And normally those GDP numbers are almost always revised downwards later.
Yeah, and still 5%. I don't think that's going to happen. And if it does, it will be because the government spent a lot on the natural disaster relief in Q4. It's spilling over into Q1. It's the whole way GDP is calculated is absurd. Not to mention you deflate it by the inflation rate, which is also massaged to death. We could see over 4%, close to 5% GDP growth, but it wouldn't be at all surprising to see the following quarter it drops to 1%.
Yeah, Chris, correct me if I'm wrong. Didn't Murray Rothbard also write that government spending should be removed from GDP, not counted as a plus?
Yeah, and so the trade deficit should also be taken into account with gross national product. Because, I think we had, if you take out oil, in January, we had a record trade deficit in all of U.S. history.
That's interesting because didn't Trump say he was going to bring more manufacturing and jobs back? So it's kind of weird then that we would still have a record trade deficit.
Yeah, and he also talked about how the budget deficit was too big. And look at him basically more than doubling it in fiscal year 19.
Yeah, I agree. He's not doing everything he said he's going to do. He also is taking credit for that stock market rally. And so now it seems the excuse is going to be that he's claiming that, if there is a stock market crash, it won't matter because of the economy. So that seems to be his new excuse. If the stock market does, continue to correct downward or crash, that he's going to say, well, it doesn't matter. The stock market doesn't matter after taking credit for the stock market the Dow going from 19,000 to 26,000, that then he'll say it doesn't matter because of the real economy.
Yeah. And you have to look at this over time. In 2008, the Dow peaked around 14,200, and that was a bubble. Now, all of a sudden, 10 years later, the economy hasn't been doing particularly well, and the Dow is not in a bubble at 26,000. That makes no sense. Then you got the talking heads on TV and media talking about PE ratios. Oh, the market's not that elevated on a forward-looking PE ratio basis, but that's the problem. In 2008, if you would have said that, early 2008, in 2009, earnings shrank for everyone. So their forward PE ratios were wrong. And I think that's exactly the case here.
Yeah, I agree. And the PE ratios would also be a lot higher if there wasn't this artificially cheap debt fueling all these corporate share buybacks. There's been over $1.4 trillion in share buybacks to goose earnings, to make earnings lower, to make the multiple lower than it really should be. I think, the PE ratio, Chris, would probably be at least 30 or 40% higher on the large stock indices if you backed out those share buybacks with debt.
Yeah, and, if one of your listeners is an investor in the general stock market and they own a company that's done a large buyback recently, they should really be thinking to themselves, why are they wasting capital on buying back shares at such an elevated valuation? That's not a well-run company.
I agree. Normally, it's how the CEO and the upper management executives trigger their stock options. So they use it to beat earnings, and then they have to do the buybacks to reduce the share count. So it's kind of financial engineering and a scheme. So the CEO of these large publicly traded companies can get rich quick, but then the companies turn into like ExxonMobil, where they have too much debt, or like General Electric, where they start to have real major problems.
Yeah, and if they have extra cash, they don't have to buy back shares. Why don't they just give it, if they can't reinvest it at a higher rate, just pay it back to the shareholder? That's why you invest in companies to begin with.
Agreed. Well, let's transition with the remaining part of the interview. I want to speak to you a lot about the gold market. So in your opinion, why did gold rise in 2017? It kind of had a stealth bull market restart there of around 13%. It's been correcting. Gold has been correcting lately. Do you think it's mostly because of a weak dollar, or do you think there's other factors why gold has started to rise?
Oh, I think there's other factors, especially institutional buying has picked up, and they tend to be longer term holders. And I also think that there's a lot more distrust of the system out there than most people realize. And then you look at the gold and silver ETFs. They've grown pretty significantly over recent years. That's another source of demand. Whether they have all that metal is another question, but I think at the very least people are buying it as a hedge. And then like it's always been, it's the East that's driving the demand, not the Western world.
Yeah, I agree with that. And also, I think the other factor that people might not be realizing is the CEO of Randgold Resources has come out again recently in the last couple of months. And he said basically that the gold mining industry was in trouble again after the gold price was down in the low 1200s, that the gold industry needed around $1,400 an ounce gold in order to start reinvesting and bringing on new supply and replacing reserves. Do you agree with his comments that the industry is dealing with huge problems in the future if the gold price doesn't start to rise considerably?
Yeah, because what the gold companies have done to cut their all-in sustaining costs, and we'll get back to that in a second, is they've cut brownfield and greenfield exploration to the bone. They haven't been trying to increase the reserves and resources. They've been operating based on what they had, and that's not sustainable. And coming back to the all-in sustaining costs, say your all-in sustaining costs are $900 an ounce, let's say. Then you have to add in the taxes you have to pay. Then there's off-balance sheet items, expenses that you have to pay, and more additional corporate expense. So that doesn't fully account for the real cost. The real cost, if you're producing at $900 an ounce, all in sustaining, at $1,300, you're probably making $80 an ounce.
Wow.
Not that $400.
Wow. Well, would you say then that the all-in sustaining cost is a huge improvement then over the cash cost numbers that the miners used to give, or do you think that they have to do a better job then of itemizing all those different extra costs that you said?
No, all-in sustaining cost is a good measure. You just have to know what to account for in addition to that. And, another good test is if you're thinking about investing in a company with a big development project or just a project developer, if they have an after-tax internal rate of return of at least 17-18%, using $1,000 gold.
Those projects, Chris, are pretty rare. How many new gold mines have those type of low costs?
You'll see a lot. Randgold is one that I know uses that. Endeavor Mining is one that they require 30% after-tax internal rate of return at $1,200 gold. So I mean, there are companies like that. Yes, it's much harder to find now, and a lot of companies will actually undertake development projects with a 20 to 25% IRR at current gold price, which I don't think is particularly smart. I think it'll turn out be okay because in the medium and long run because gold prices are headed higher. But that's how you really know what a great project, if it has the economics such as that. It can withstand the whole commodity cycle.
That's a good point. Now, I know you guys during this bear market since 2011 in gold and silver have found a lot of winning stocks despite the gold and silver price, not doing very well. David Morgan, I'm sure once this interview comes out, there's going to be lots of at least 3 trolls underneath the interview commenting how David Morgan is never right, doesn't pick out winning stocks. I think these trolls, though, are too cheap, Chris, to go out and pay to buy your newsletter and read it. I've read it, your newsletter, for years now, and I know that you guys have picked out winning stocks. Talk about some of your winners. I know you guys got a 30 bagger in the last couple years, and you've had other winning stocks. So talk about how you've been able to find some of these winning stocks that make your subscribers money, newsletter subscribers money, despite the bear market.
Well, it's been hard overall. Overall, our recommendations haven't performed that well over the last 8 years, just because in general, the mining indices have done terribly. But within that, we look for special opportunities. The one you mentioned was a 30 bagger. That's if you got in on the private placement. We were lucky enough to do so. And that was late Q1, early Q2 last year. And even if you got in when it started trading, you were up 4 to 5-fold by year end. We have an exploration play that's up, I think, 70% this year. And, it hasn't been a good year for the miners. It just takes patience, and you got to look everywhere. And, we don't confine ourselves to gold and silver. We look at other commodities.
Yeah,
for example, Trevally Mining did very well last year. It's a zinc play.
Yeah, I know you've been bullish zinc for a while now. Are you still bullish zinc?
Not nearly as bullish as I was, just because I don't have a favorable view of the global economy over the next several years. There is still time for it to move higher, possibly $2 a pound. But, it's never wrong to take some gain along the way.
So you don't think then that the zinc price has risen just because China has been stockpiling some of these base metals? Like, I think a lot of the copper price rise, China has been stockpiling it. There was a short squeeze in the copper price, and it seemed the copper rally wasn't really sustainable. And so the copper price has been crashing lately after its big rally.
So the story with zinc is, there's a story on the demand side, but the real story for the price rise, which, we were on this really early, was the supply side. A lot of primary zinc mines or large lead zinc mines were either contracting or coming offline from 2015 through 2018. And, even if you look at the LME zinc inventories, they've been falling for about 2 years now. So that zinc is really more of a supply side story.
And speaking of supply side, do you see future supply problems with silver if the silver price doesn't start to rise significantly? Say we don't see $25 or $30 an ounce silver in a few years. Do you think a lot of these primary silver miners are going to have real trouble replacing their economic reserves?
Oh yeah, I mean they're having trouble already. Most of the most talked about primary silver miners, except for the likes of, say, Fresnillo, which has some of the best assets in the world, haven't been increasing reserves. They've been mining them faster than they've been replacing. I don't think there'll be a shortage in silver. I mean, there's about 2.5 billion of above ground inventory. But yeah, the silver price, that needs to increase. If not, it's used so widely in industry that the market will push it up if prices stay this low for much longer. The thing is, gold miners are making a lot more money relative to silver miners, adjusting for scale. Their margins are much higher.
Do you think that...
So
sorry, go ahead, continue.
I was going to say, if you think that there's going to be issues replacing reserves in the gold industry, it's going to be magnified that much more in the silver industry.
Do you think in general the industry has done a good job cutting costs the last 7 years during the bear market, or do you think there's a lot more costs that can be cut?
I don't think there's any more costs that can be cut. The costs have started to rise because companies now have to invest more in exploration, whereas they were able to ride out some of the worst years of the bear market on existing reserves. So now more spending is required. And, also projects are nearing the end of their mine life, so companies have to replace them with new projects.
That's a good point. You mentioned mergers and acquisitions, so there's been some M&A deals recently. First Majestic Silver was able to go out and buy the San Dimas mine from Primero, their one remaining asset. Do you think that was a good deal?
I thought it was a fantastic deal. First Majestic has the money to invest to operate that mine very, very profitable. And they got it very cheap. They paid, or they will pay Silver Wheaton about $150 million in stock to restructure the stream. That's going to increase gross margins by 30-40%. It's extremely attractive now. The previous silver stream was too encumbering on the economics. So, this should be a mid-high single-digit producer in about 2 years. All-in sustaining costs, that is, in about 2 years, once First Majestic has had time to invest enough in exploration and mine development. And, it'll be a 6 to 7 million ounce per year silver mine. So, that's a lot of cash flow they acquired it for approximately $320 million.
And First Majestic Silver is going to end up being one of the largest senior silver producers in the world then. So they've taken advantage of this bear market to do a deal like that. If the silver price had probably been a lot higher, I doubt that deal would have been available.
Yeah, Primero would have been in too good a shape to have to offload that project so cheaply.
Is there any other mergers and acquisition deals that you like that have gone done recently?
Leah Gold making a bid for Brio Gold. It's hostile, but they have support of Brio's largest shareholder, Yamana. I think they own about 56% of it. So at this point, there's a low execution risk of the deal getting done. They did pay a 50% premium to the 20-day volume-weighted average price, but it was already it's still well below net asset value.
And Leah Gold is a relatively new gold miner, right? That billionaire Frank Giustra put together, and I think you've been on that story for a while. You found that company pretty much before a lot of other people covering it in the newsletter industry.
Yeah, and they have a fantastic CEO in Neil Woodyer. He was formerly at Endeavour Mining, and that's been a great success story in West Africa. So they have all the right people. That's what I basically bought in on initially, was the people.
Yeah, management team.
That's what you have to do.
Yeah, I agree. Management team is very important in this industry because I've seen bad CEOs ruin good assets. I'm sure you have too.
Oh yeah, that happens far too often.
Klondex Mining is another company that you talk about a lot. So they're a new producer in the Yukon, right? That's been producing a gold mine for a couple of years now, and they have a large expansion plan.
No, Klondex is a Nevada-focused producer, and they have one project in Manitoba, but they're having issues with it. It is narrow vein, so they have suspended that. Unfortunately, the share price has been taken out back during this downturn. But, they have what is, I think, the highest grade gold mine in the world at Fire Creek. It's a little over an ounce per ton.
Wow.
And they have a nice development project in Hollister. That's another very high gold silver grade mine that they will do a bulk sample on this year and start development in the second half. And because it was a previous producing mine, they'll be able to get it in production by early 2019.
We'll be right back with Chris Marchese after a word from our sponsor.
Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed, big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/WS4MS. That's healthiq.com/WS4MS. You taught me about royalty and streaming companies many years ago and explained to me how they worked and how they're different than regular mining companies. Since starting in 2004, according to Nolan Watson, a presentation that he put out recently, there was only about $2 billion in market cap in 2004 royalty and streaming companies. Right now, there's at least $35 billion in royalty and streaming companies. Do you think they've benefited from the paper bear market manipulation since 2011, the royalty and streaming company industry?
Yes, they have. Because one, I mean, if you look at it for the deals that they pay in paper with, or, issue equity to finance, those aren't nearly as accretive as deals they can do with either debt or their ongoing cash flow generation. The reason is because they have a fixed cost structure, their cash flows are going to remain robust even during low price environment, especially a lot more robust than the actual operators. So, I mean, if you look, all the deals that Wheaton Precious Metals, Royal Gold, Sandstorm, and Franco-Nevada did over the last few years, I mean, they've spent several billion, I think upwards of $5 or $6 billion on deals. And I think those will create a lot of value when the price of the metals goes higher, because it's become so competitive that now a lot of these deals are done with mid-single digits internal rates of return. It used to be they used to do them at about 20%. Wheaton Precious Metals, because they were the first ones to do it, did it at 30%. So the deals haven't become nearly as cheap as they were, but it's still a very attractive way to garner leverage to moves in the commodity prices.
Yeah, that's a great point you made about the competition in the space. That Sandstorm Gold talked about this on a conference call in the last year or so, that there's so many, not only is there competition with Osisko Gold Royalty, who's one of the newer big players too, but there's so much private equity money and even pension funds getting involved in bidding on these deals that the internal rate of return is becoming at some point 1 or 2%, 0%, or even a few deals at negative. So some of those are the private equity guys saying that, oh, we'll just, if we can't sell this deal later, we'll just spin off the company and put it on a publicly traded exchange and it'll still do, the share price will still do.
Yeah, exactly.
So do you think then that royalty and streaming companies are a lot safer then? They're kind of, would you say then they're kind of like a mining stock ETF then, especially like a larger one and is immature? So, your Franco-Nevadas and your Wheaton Precious Metals and your Royal Golds, they have a good amount of diversification compared to maybe like a mid-tier primary gold and silver miner that only has like maybe 5 or 6 mines.
Oh yeah, and the upside isn't as great. I mean, if you're able to buy a really good mid-tier miner, the upside is a lot higher. But then there's also more risk because they have operational diversification risk, geopolitical risk. These royalty and streaming companies have diversified it to the point that it's negligible. Those risks are negligible. So, I mean, I think having 2 or even 3 of those in your portfolio, a resource portfolio, should be a core holding.
Yeah, I completely agree. And, to add to your points there, Sandstorm Gold has really turned things around. Initially, when that company started, they only had, I think, 3 or 4 assets from all junior miners, and now they have a lot better counterparties. So the company is maturing now. They have, I think, 20 assets or 21 assets generating cash flow right now, and in only a couple of years, they'll have almost 30 assets generating cash. So it just goes to show you that during a bear market for 7 years, that yes, they have diluted their shares, but they've turned the company around. It's a totally different company than when it started.
Yeah, point.
Well, Chris, are there any stocks you're buying now? Are there any stocks that you like that you're willing to share with our listeners for free, or are they going to have to go out and buy your newsletter?
I'll just name a few. Leah Gold and First Majestic. I like those here. Another one is Torex Gold. Their primary operation is actually adjacent to Leah Gold's Los Filos mine in the Guerrero Gold Belt in Mexico, which, is a dangerous place. But what has happened recently is there was an illegal blockade, which the Mexican authorities actually cleared. They actually did their job for once, and you don't see that much in Mexico. And the stock has not priced that in whatsoever. I mean, I think the 52-week high in Canadian dollars was 32.85. The 52-week high was 32.85, and it's trading at 12 now. They have a large open pit, low cost operation that's ramping up, a very high-grade subsill development project, underground development project, and another very large open pit mine close by for growth. If both those mines are online, it's a 800,000 ounce producer.
Oh, sounds like
there's a lot of
sounds like a potentially good value. Yeah.
Yeah, and another thing is, I think they will probably try to diversify a little bit. They have a very tight share structure. I believe it's under 85 million shares, and that is fairly rare to find these days.
Well, I'm sure our listeners will enjoy doing some research on that. I think gold stocks, now that people have made a lot of money in the bond market and real estate and stocks for the last few years, there is money, like you said, especially institutional money that's rotating out of those asset classes because of the valuations and looking for undervalued assets.
Yeah, I mean, it still isn't happening on a large scale, as we can see by the prices, but that could change very quickly.
And the last question before I let you go is about cryptocurrencies. I know you kind of live out there in Northern California, not too far from the Silicon Valley area of San Francisco and San Jose. Does that area have cryptocurrency fever right now?
Yeah, people are excited about it. I mean, I would say they're more curious than that involved. And, I noticed it's really calmed down, with this big correction in all the cryptos. I used to have people asking me questions about it, every other day. And now there's nothing.
Yeah, I had the same thing. When the prices were moving up, I had people coming out of the woodwork, people posting on Facebook that I didn't even know paid any attention to financial markets. All of a sudden, they were Bitcoin and cryptocurrency.
Yeah, and a lot of people made money in Bitcoin, and that's great for them. But imagine all the people that lost money. I mean, a lot of people that bought it at 12,000, 14,000, 16,000, 18,000. I mean, there's a lot of those too. And people really don't think about it like that.
Well, I mean, 90% of all small businesses fail. So, I mean, whether it's a market or you're actually starting a business, the odds are against.
Yeah, but, a lot of people thought this is kind of like during the tech bubble when people were just buying things with tech in the name. They expect to, get rich quick.
That's
and
a great point.
Unfortunately, that's just a wrong approach to making money in the market.
Yeah, I completely agree. But it's human nature, the herd mentality, and the whole efficient market hypothesis, in my opinion, is BS, because it assumes that human beings are rational creatures that make sound investment decisions, and that all information is priced into a market. And I think you and I know that that's not the case with markets, that people are mostly irrational and they oscillate between the two main human emotions of fear and greed.
Yeah, and the key is to keep emotion out of it. And that's a hard thing to do, but you have to train yourself to do it.
So you are not buying any Bitcoin or cryptocurrencies after this crash then?
No, I sold all of what I had, which was it was an okay amount. I did it as a speculation. I sold it all on January 1, just so I can avoid taxes for another year.
I'm sure there's
I don't think, if it went down another 80%, I would probably get back in. But, there always could, if I know Sprott launched or is launching a gold-backed crypto.
Oh, there's dozens of those. The Perth Mint is launching one. There's a number of gold mints that are launching them too. Anthem Blanchard has launched one. So there's like a dozen of those gold-backed cryptos. Bullion Coin from Andrew Maguire. There's a bunch.
Those are legitimate because if you can take delivery, some offer delivery for your tokens, and that's legitimate. That has sustainability.
I don't see the need to put a cryptocurrency token on it then if you're just going to get the metal delivered.
Well, but in case you want to get it delivered, that is always, because if you can't touch it, you really don't own it. That's how I think.
Yeah, except for gold money, which I like gold money, but then you have a gold-backed debit card, and there's more stringent, like independent audits in place there. So there are some other bullion companies that do storage, but yeah, I mean, people should definitely own some of their own physical. The thing is, Chris, what do you think then about governments? So do you think then ultimately in the future, after the next financial crisis, that the governments are going to do some type of debt reset, and then they're going to potentially maybe issue like windfall profits taxes on gold and silver if they do go crazy, and also cryptocurrency? See that in the future potentially?
I honestly have no idea, because I think we're going to be in such a mess. There are so many different potential outcomes. And, if they do default on their debt or something of that nature, inflate away, that could lead to war with the Eastern world, because they hold a lot of our debt and a lot of Western world debt. And if we basically just renege on it, they're going to be pissed. So, there's always that possibility. It doesn't have to be an actual war, but a financial war. I have no idea.
I think that's actually a good answer, because there's a lot of experts out there that seem to know exactly what's going to happen. There's been certain people that have been predicting hyperinflation for many years since 2009, when the central banks intervened, that said hyperinflation. There was a lot of more contemporary Austrian school economists that were saying that hyperinflation was going to happen immediately once central banks intervened in 2009. And then there's also the other experts that use like fear porn to sell paid newsletters. And so they've been calling, basically for the last 6 or 7 years, they've been calling for a 50% or more stock market crash for every 2 or 3 months.
Yeah, there's been a lot of crazy calls the last 10 years. And, people will continue to make them, especially in this wacky world of no price discovery in anything.
That's a great point. The price discovery, that's the main thing that the central banks have distorted. So yes, there's stock prices and bond prices, but it's not real discovery, because there's all this, there's high frequency trading, there's manipulation of markets, there's plunge protection teams and central bank intervention. And so that's not a free market. That's, really, really distorted market that can go up or down basically at the whim of, a central planner.
Yeah, so listen to this interesting fact. So if since 1993, if you were to do the following every day, you would have returned a total of negative 5%. If you were to buy the SPY, the S&P 500, at the open and sell it on the close every day from 1993 till present, the end of January, you'd have returned negative 5%. But if you would have bought it on the close and sold it on the open every day since 1993, I think you would be up 575% or about that. So the probability of those numbers are in the hundreds of billions to one, if not higher.
So that signals to you then market manipulation.
Yeah, all the buying's being done overnight. It doesn't make a lot of sense.
Yeah, I agree. And you talked about that in your book, Silver Manifesto. You talked about the Sharpe ratio for gold and silver markets too, with the probabilities of, the price movements for gold and silver.
Yeah, all markets are manipulated today. That's just a fact. It's not even debatable.
Well, I hope this ends at some point in the future. I'm getting really tired of it, but unfortunately, Chris, and we've highlighted this in this interview, I think things are going to get worse before things get better, because most people don't care, as long as the stock market's going up and cryptocurrencies are doing well. The majority of Americans don't really.
Yeah, exactly.
Well, Chris, I enjoyed our discussion today, and I'll have to have you back on again in the near future. I really enjoy your insights on gold and silver. I've learned so much from you over the years. If our listeners want to subscribe to your newsletter at the Morgan Report or read your book, Silver Manifesto, which is available on Audible audiobook, how do they?
If you want the book, you just go to Amazon, and there's a link. You get it on PDF or Kindle or Audible. And to subscribe to our newsletter, just go to themorganreport.com, all one word, and you get a free 30-day trial.
Excellent. And I know you guys do a really good job over there, so just ignore the trolls that probably have never paid a dime for your newsletter and probably won't pay for anyone's newsletter, and they definitely haven't read what you guys have been writing about. So even though the gold and silver industry necessarily as a whole hasn't done that well, I think you guys should definitely keep up the good work, because I've seen your posts on Facebook and some of your other successes. I know you're a hardworking, successful guy. You're only, 33?
Yeah. Yes.
Yeah, so you've achieved more success in your life than most people twice your age. So I know how hard you've worked.
Thank you.